Today, we're doing a complete breakdown of AASB 16. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying AASB, prepping for a Big Four interview, or working in finance, this is everything you need to know. For years, companies could hide massive liabilities through operating leases. Picture a large retailer with $100 million in lease commitments, invisible to investors. AASB 16 pulled these onto the balance sheet, giving a clearer financial picture. By the end of this section, understand how this transparency impacts financial statements. AASB 16 emerged to tackle the lack of transparency in lease accounting. Previously, operating leases were off-balance sheet, which distorted financial metrics. With this change, every lease appears as an asset and liability, aligning with finance leases. This clarity helps investors make better decisions, knowing the true leverage of a company. Entities using AASB have adhered to its requirements since January 2019. The primary mandate is to recognize both the right of use asset and lease liability, ensuring all entities from large corporations to SMEs present a comprehensive financial picture. Exceptions include short-term leases and low-value assets, which maintain simpler accounting treatments. This standard ensures uniformity across financial statements. AASB 16's lease accounting model transforms how leases impact financial statements. Every lease becomes a balance sheet item, just like previously restricted finance leases. This shift influences key metrics like asset turnover and leverage ratios, offering more precise insights. For interviews, understanding how this comparability across industries aids stakeholders is vital. This model simplifies complex leasing arrangements into clearer, comparable figures. Understanding scope is crucial because many candidates forget that leases for minerals and similar resources are not covered by AASB 16. That's a classic interview trap. Make sure you're clear on what the standard includes and excludes to ace those tough questions. AASB 16 applies to almost all lease agreements, particularly those that aren't short-term. If the lease term is longer than 12 months, it falls within the scope. This standard also covers subleases and modifications, ensuring transparency when lease terms change. Even low-value assets like smartphones can be included, provided they're used by the lessee. This broad application is designed to create uniformity across various sectors, offering a comprehensive view of leasing obligations. Certain leases are explicitly excluded from AASB 16. Leases related to mineral exploration or use are not covered, as they're governed by different accounting rules. Biological assets like livestock are also out due to their unique valuation methods. Intangible assets such as patents don't fall under this standard, following separate guidelines. Additionally, service contracts that don't confer control over an asset's use are excluded, emphasizing the distinction between service and lease. A lease under AASB 16 is an agreement that grants the right to use a specific asset in exchange for payment. Picture a company leasing office space. It gains the right to use that space for a set period, paying monthly rent. These leases must specify the asset, unlike service contracts that focus on outcomes rather than asset use. Payments are typically periodic, aligning with the asset's usage over the lease term, making it a key financial commitment. The right of use asset is central to AASB 16, representing the lessee's entitlement to use a leased asset. Imagine leasing a vehicle for business. This asset is recorded on your balance sheet at its initial cost, including all related lease liabilities and direct costs. Over time, it depreciates like any physical asset, reflecting its consumption. If lease terms change, so does the valuation, ensuring financial statements accurately represent current commitments. This asset's inclusion transforms how leases impact financial visibility. Scope edge cases can catch you off guard. If a sublease suddenly extends beyond 12 months, it becomes part of AASB 16. Leasing a low-value copier for essential office functions may also fall under this scope if deemed significant. Conversely, a service agreement for using equipment without owning it stays outside. No identified asset, no lease. And remember, leasing mineral rights like oil extraction remains excluded, governed by industry-specific accounting. These nuances are essential to nail down scope accurately. Financial statements once hid leases off balance sheet, obscuring true liabilities. With AASB 16, companies now report leases upfront, offering clear visibility of their financial obligations. This transparency affects decisions, from credit ratings to strategic investments. Let's explore how this model requires businesses to rethink lease management. AASB 16 requires leases to be recognized as both liabilities and assets. Our journey follows Meridian Corporation's $10 million SaaS deal, spread over a 3-year term, with $8 million for software licensing and $2 million for implementation services. This example illustrates how businesses account for lease contracts comprehensively. For Meridian Corporation's $10 million contract, the first step is determining if it's a lease. Control over Acme's software signifies this is a lease. Misidentifying such contracts as service agreements is a frequent error. AASB 16 mandates recognizing control and asset specificity, solidifying this as a lease. This clarity sets the stage for accurate accounting. With Meridian Corporation's lease identified, the next focus is the lease term. Here, it's a straightforward 3-year period with no expected renewals. A common misstep is ignoring renewal options affecting liability measurement. Under AASB, this evaluation considers all influencing factors. The certainty of this term informs subsequent liability calculations. Having established the lease term, Meridian Corporation calculates its liability by discounting $10 million over 3 years at their borrowing rate. Misapplying discount rates is a frequent pitfall, distorting liability figures. AASB mandates using either the lease's implicit rate or the lessee's incremental rate. This yields a precise lease liability figure, crucial for balance sheet accuracy. With liability calculated, Meridian Corporation now recognizes a right-of-use asset. This asset matches the lease liability of $10 million, adding direct costs. Often, direct costs are ignored, leading to asset undervaluation. AASB requires these costs be included, aligning asset value with lease liability. This ensures balance sheet alignment and prepares for ongoing lease management. Finally, Meridian Corporation measures lease payments, reducing the liability while recording interest expenses. A common misstep is neglecting to adjust liabilities and interest, skewing financial reports. AASB requires continuous measurement of liabilities and interest for faithful representation. This dynamic process ensures Meridian's financials accurately reflect lease impacts, linking back to the initial $10 million contract. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. AASB 16 revolutionizes lease accounting, bringing leases onto balance sheets, affecting both assets and liabilities. This change mandates a sharp focus on measurement and transparency in disclosure to ensure accurate financial reporting. When recognizing a lease under AASB 16, finance teams need precision. At the lease's start, you must record both a liability and a right-of-use asset. The liability is valued at the present value of future lease payments. Importantly, low-value assets, often under $5,000, aren't subject to these recognition rules, simplifying the process for smaller items. Once a lease is recognized, ongoing measurement is key. Remeasure the lease liability when future payments change, impacting the right-of-use asset. Depreciate this asset over the lease term or its useful life, whichever is shorter. Triggers for reassessment include lease term changes or shifts in index rates affecting lease payments, ensuring the books reflect current obligations accurately. Presenting leases accurately transforms financial statements. Right-of-use assets fall under property, plant, and equipment, while lease liabilities are split into current and non-current sections. Interest on leases appears as finance costs in the profit and loss. Disclosure notes must reconcile lease liabilities with right-of-use assets, ensuring full transparency and aiding analyst scrutiny of asset and liability management. Mandatory disclosures under AASB 16 enhance transparency. Report the total cash outflow for leases, offering insights into liquidity impacts. A maturity analysis details lease liabilities, crucial for understanding future cash commitments. Disclose assumptions regarding lease terms and options, providing clarity on potential risks. These disclosures, both qualitative and quantitative, empower stakeholders to make informed financial assessments. Picture a CFO managing a $10 million lease for office space. Initially, they record both a liability and a right-of-use asset. When rent increases by 5%, they adjust the liability and asset values. Annual disclosures show $1 million in lease payments, crucial for cash flow forecasts. This CFO also details lease term assumptions in reports, helping stakeholders understand potential risk exposures, ensuring informed decisions and strategic transparency. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Under AASB 16, operating leases are recognized on the balance sheet. Meridian records the right-of-use asset and corresponding lease liability at the present value of lease payments, $1,200,000. This entry reflects the obligation to make lease payments and the right to use the leased asset. Upon making the first lease payment, Meridian reduces the lease liability by $240,000. Interest expense of $60,000 is recognized separately, representing the cost of financing the lease. This reflects the ongoing financial impact of Meridian's lease commitment. Depreciation on the right-of-use asset is recorded at $240,000 per year. This allocation reflects the asset's consumption over the lease term. Meridian systematically recognizes the cost of using the leased warehouse, which reduces the asset's carrying amount. Each subsequent lease payment requires adjusting the lease liability. Meridian again pays $240,000, with $45,000 as interest. The decreasing interest expense shows the reduction of the liability over time, reflecting the diminishing cost of borrowing. A modification in lease terms results in a $100,000 increase to both the ROU asset and lease liability. This reflects the additional obligation and asset value due to higher future payments, aligning with AASB 16's modification treatment. Year-end adjustments capture the cost of leasing through interest and depreciation. Meridian calculates $50,000 in interest and $250,000 in depreciation, ensuring financial statements accurately reflect the asset's consumption and liability cost. With this final payment, Meridian Corporation reduces the lease liability by $240,000. This payment marks the approaching end of their lease obligation. The decrease in liability aligns with Meridian's strategy to manage long-term commitments. De-recognizing the lease liability and ROU asset at lease end marks the conclusion of the lease. Meridian clears $60,000, aligning the balance sheet by removing obligations and assets no longer applicable, completing the life cycle of the lease under AASB 16. Every Big Four and investment bank interview on AASB 16 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. AASB 16 is the lease accounting standard requiring all leases to be recognized on the balance sheet as assets and liabilities. It was introduced to increase transparency and comparability by eliminating off-balance sheet financing. Misclassifying leases was common, so now the right-of-use asset and liability must be recognized. Remember, transparency drives better financial decisions. Under AASB 16, a company records a new lease by recognizing a right-of-use asset and a lease liability. The asset is measured at the lease's commencement, while the liability reflects the present value of lease payments. A common mistake is ignoring variable payments, so ensure they are evaluated. Precision in initial measurement is crucial for accuracy. AASB 16 and Indian Accounting Standard 1116 are similar, but differences exist in options for low-value asset leases. Indian Accounting Standard allows more exemptions, potentially impacting financials. Also, Indian Accounting Standard may have different treatment for non-lease components. Misunderstanding these can lead to incorrect application. Key takeaway: no regional variations to avoid errors. Calculate lease liability by discounting future lease payments using the interest rate implicit in the lease. If unavailable, use the lessee's incremental borrowing rate. A common mistake is using the wrong rate, which skews liability values. Accurate interest rate usage ensures precise liability reporting and impacts financial ratios significantly. Lease term miscalculation occurs due to overlooking renewal options or termination clauses. AASB 16 requires including these when they are reasonably certain. Misjudging certainty leads to errors impacting asset and liability values. Always assess lease terms comprehensively, considering all contractual rights and intentions, to ensure financial accuracy. Key disclosure requirements include details on lease liabilities, right-of-use assets, and maturity analysis. Companies must also disclose expenses related to leases and variable payments. A common oversight is insufficient detail on assumptions used. Comprehensive disclosures foster transparency, enabling stakeholders to assess lease impacts on financial positions accurately. Under AASB 16, the distinction between finance and operating leases is eliminated for lessees. All leases are treated similarly on the balance sheet. This prevents hiding liabilities off balance sheet. Understanding this shift is crucial as it affects financial statements and key ratios. Always present comprehensive lease recognition. Variable lease payments are not included in the initial lease liability measurement under AASB 16, unless they depend on an index or rate. This can lead to underestimation if not accounted properly. Ensure to evaluate adjustments periodically to reflect true financial obligations. Key takeaway: monitor variable payment triggers closely. A car lease is typically included under AASB 16, requiring recognition on the balance sheet. Misunderstandings arise from historical exemptions or bundled lease components. Failing to recognize this can lead to balance sheet omissions. Remember, AASB 16 aims for comprehensive inclusion to reflect actual financial commitments accurately. AASB 16's objective is all about transparency, bringing lease obligations onto the balance sheet. It covers most leases, ensuring lessees recognize both lease liabilities and right-of-use assets. Leases are defined by the right to control an identified asset, with control implying economic benefits and decisions over its use. An important point: lease term includes extension options, affecting both liability and asset measurements. Under AASB 16, lessees bring leases onto the balance sheet with right-of-use assets and liabilities, initially measured at the present value of lease payments. Don't forget, interest rates and direct costs factor in. Short-term and low-value leases get special treatment, typically bypassing balance sheet recognition. Remeasurement is crucial, especially if payment terms change due to inflation or interest rate shifts. When preparing for interviews, know AASB 16's intricacies. Common pitfalls include misclassifying leases as service contracts. While aligned with International Financial Reporting Standards 16, local nuances may arise. Disclosures are demanding, covering everything from maturity to cash flow impacts. Remember, lease payments hit financing and operating cash flows differently. Transition wisely with retrospective options, and keep practical expedients in your toolkit for simplifying reporting. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.